Good morning, traders. Hope you're well. If you have not seen the first two videos, I advise you go back there and just have a little bit of a brief overview, as we're going to be touching on certain fundamental and technical analysis, even risk management and trader psychology in each video. As we mentioned beforehand, before we start the day, we tend to look at the economic releases so we know whether or not to expect some volatility throughout the day. So over here, we can see later on today, we are going to have US retail sales. Now, that would normally be a nice market moving event, but as we know, tomorrow we have FOMC. So that will likely be a muted response on the retail side, just while people hold back, stay on the sidelines until we know which way the interest rates are going to go. And more importantly, we listen to what the Fed has to say in terms of what the expectations are over the coming weeks, months, and quarter. Right. So let's jump into the technicals. We can expect some volatility going into later on today, but as you can see here, we normally just back up a little bit. You can see here's the rising trend line, as we've been pointing out. One thing I do want to point out is that I kind of cleared up the screen a little bit. We're now looking at a daily chart. And there we go. We're kind of looking at a daily chart. And we had a channel going up, and we've been talking about this ABC correction. Now, the thing about this ABC correction, which has kind of been bugging me, that is if we do have a leg down, okay, if it's the same length, there could be a scenario where we break through this bottom line. Now, the reason why we're saying it's an ABC correction, because it's going down into this kind of area right now, over here, which is about 220 days after the last a sell-off, which was around about here, right? So that being said, let me just adjust the screen, sorry. Let me just get the screen a little bit right here. There we go. You can see it a little bit better. So what we might have, I'm going to put forward an alternative pattern that I've been looking at. At the moment, we are up at this level here. We've retraced roughly 50%. This line here going in for a potential ABC correction. However, one thing I have noticed is that if we drew this line like that, we've hit the top there, which coincided with this line here that's going down, the resistance levels that are descending. And one thing that is clear is that we could potentially have a scenario where we go like this. We kind of go down, bounce off these levels here, bounce out, because this is actually a very strong support resistance. We bounce off there, then we go up to this line here, or even that line, where we start testing all-time highs. And then from here, because we're so far, we're up in the 120s, then we have our descent down into this sell-off. And it goes down to about the same levels here. Because I mean, over there, you'll have a very nice drop. You'd have a fairly significant sell-off before going higher. And what this does, it actually forms a head and shoulder pattern, right? So we could have a scenario that goes like this. There's your shoulder, head, and then goes up to that, goes onto your right shoulder, and boom. So we could have a head and shoulder pattern that is created, and that descent into the timing band is going to form the right shoulder of an inverted head and shoulders, then goes higher. Now, the point I'm trying to make, it may not follow that. It's very speculative, but it is a possible path. So what we're doing is we don't have to figure out if that's exactly what it's going to do, but as we go forward in time, it will start unfolding. We will find out if this is an ABC correction, if it goes below this line here, and breaks below this channel, well, then we know it might be going down for an ABC correction. If it bounces off this level and it goes up and breaks through this descending resistance, well, then we know it could be going up, actually just keep on going up, or it could kind of consolidate into some kind of an inverted head and shoulder and then go further up. So I thought I'd just point that out there. In terms of where we are now, we've taken this position over here. We've been short for a few days. I think it's worth mentioning that anybody who's following these trades, you'll see here, our account balance, we started off with $10. It's now $10.33. So 33 cents has popped out of nowhere. What that is that we are currently short when funding rates are positive. What that means is if you've got positive funding rates, it means more people are long than they're short, and therefore the people who are long, they have to pay interest on their long positions, whereas when we're on the other side of the trade, we're on the short side, so we actually receive that. If there were more shorts than longs, well, then funding rates go negative and we pay to take our shorts because there's more demand to go short, right? So if you wondered why we actually started off with $10 and we got 33 cents out of nowhere, well, that is because we are short during, while funding rates are positive. So let's go back. Now we're on the going to the 4-hour chart. Something else worth mentioning, you will see that, as I mentioned yesterday, this was a very poor entry. I mean, if I do say so myself, I mean, if we look over here, the short position, we got it over here. We're aiming for the bottom of this channel and this support resistance level, but we want to put the stop loss just above this descending. So if you look over here, at that point, 18, let's say 118700, it was up here somewhere. That gives us a risk reward of 1, which is really not good. But as we go forward in time, this descending resistance line comes further down. So we can adjust our risk down. When we get to, I don't think it's going to happen, but let's just say the markets consolidate sideways until we get to the 29th of September. That line would have come all the way down and negated our risk. Okay? It would have come sorry, let me just get rid of that. Can't move this now. That would have come all the way down and negated our risk. And now we've suddenly got a risk reward of 11, right? But that's because our risk is going down. That's one thing what I enjoy about descending or ascending trend lines is that the further you go forward in time, the risk reduces somewhat. So we're trying to use that in our favor. That being said, this was a terrible entry that I picked up, but it's okay. So what we're expecting now is for the markets to they can shoot up, it can happen, but we are expecting some volatility tomorrow, right? So what we're going to do, today is the 16th, so if we go through to the 17th, about there, we are going to expect in this little timing band here, let's see, that's Wednesday, midday, about there, that's when the FOMC comes out. Now, I can expect some volatility coming out of that. If you look, that resistance, that support, coincides with that diagonal. And so I'm going to be very speculative right now and give a potential way this could work out. We could have a scenario where FOMC volatility pushes down the price over here. If Powell does not decrease interest rates, it could be a bit of a sell-off on the US equities market, pushes Bitcoin down, and then what we can do, have a little spike down, touch this bottom barrier, all right? And then buy back up. Because when you have a quick spike down and then up again, you'll have this big wick to the downside, which is normally a pattern that happens before you go higher, okay? So if we go look over here, you see these little wicks down there, reversal patterns, pushes it up. Over here, look at that one. That was a nice one, pushing it back up. So you normally have these wicks that happen before it changes direction. And we could potentially have something here, or it will just push up. But either way, I think the point I'm trying to make is that the FOMC should give us some volatility to get out of this consolidation. Right, so that's worth noting. I'm going to leave it at that. What we're doing is, again, we're waiting for the FOMC. We are short, not the best entry, but this is more about trying to instill certain trading behaviors, because I'm a firm believer of the fact that you can be right 70% of the time, but if you don't have the right trading technique, well, then you will lose money. And on the flip side, you don't have to call it right all the time. You don't have to always be right as far as going up or down, but if you're minimizing your losses and maximizing your upside with a good risk reward ratio, getting in at the optimal points in time, easing into your position, never doubling up on your position, and we'll go into that another time, but never entering a position that is twice or increased in size than your previous position. What you do is you go in at the very least, you go in at the same amount, and maybe you add your position if your account has gone up, right? If it's still within a certain amount, like let's say it's between, say, $50 to $100 or whatever it is, you say that between $50 and $100, you're only going to risk X amount, and you're going to keep that constant. It doesn't matter if your account's $60 or $90. You trade the same size, okay, so that you can always be right and wrong equally, and it won't draw you down, and then your risk reward ratio should push your account up. So just something to bear in mind. But either way, round about this time, we are expecting a little bit of volatility that will either push up, either push us like that. Actually, it could do something like that, okay, or can go something like that. But then equally, if it does go below this line here, we likely are going lower. We'll bounce off this one. Yeah, we'll go down to 105. If we break down this through this one, we will likely go down. So I'll leave it at that, guys. Happy Tuesday, happy trading, and I'll do another update tomorrow. I will leave these updates at about 10-15 minutes each. I think the first two were only there to get some kind of a foundation in terms of looking at your fundamentals, the kind of technicals, how we got to this point. But I thought I'd just clean up the previous patterns just so you can kind of have a better idea. One thing that's worth mentioning, you probably noticed there are two lines going like this. And let's just have a reminder here. We drew this one, was there. That's our line over here that we took, all right? Let me quickly just get rid of these. We then cloned this, and then we took it to the top. Sorry, we took that to the top like that. But you can see it bounced off there, and then that's where it closed. That was just a wick is in terms of a reversal. So we could bring that to the bottom of the close. And you'll notice where that closed, that now coincides with our wick over there. So what we could have, I call this the wick zone, right? This is normally where we'll have the reversals happen. By making that parallel, I can expect something where it goes like that, boom, boom, and then you'll have this wick that'll go up in that zone and then reverse lower. Okay, it's only for closes above the second descending line. Just remember a close above that. Then we can say that's fine, that's broken. And again, like I mentioned yesterday, not the definition, but kind of an explanation of what is a false breakout. It is when it goes up, but then reverses all the way down and closes on the same side as the support and resistance. So if we had to bring this one down over here, you can see that would have been a false breakout, because what it did was it went up, reversed, came down, and then closed back below. And the only thing above the line where it should have been a breakout is a wick. Now that can happen on a 4 hour, on a daily. Dailies are probably more accurate. The higher the time frame, the more accurate they tend to be. But 4 hours is also really good. I think those are your main ones. I normally go down to a 30-minute just when I'm trying to go in and out of these positions with a little bit more accuracy, because again, we are trading on leverage, so we want to make sure that we get in at the optimal amount. And the more the closer we are to that breaking point, then the better. Before we go, let me just quickly show you the other ones. You can see here, this is GRT. We're bouncing off this little support. If we do go down, we'll probably test the bottom of this range and then go up. Radium, it's hanging on. I mean, that is hanging on right there on that rising support. I'm itching to take a position in that because, hey, I'm kind of bullish on the project, but moreover, I just love going long or short at support or resistance. It's just your risk reward is just so good if you're able to get on that line. And it kind of, you know that you're only a millimeter away from it being invalidated, like 0.5% or something. So your risk can be really small, but the upside can be potentially quite large. And then obviously Drift, I think that's a great project as well. I like this one. Again, we are showing some good price action here. But again, look, we can apply this to almost all of the alts. I mean, you can see, this is SUI. Again, you have this ascending triangle. You got all these different support resistance zones that it's been bouncing in and out of. But the trend tends to be kind of to the upside like that. So if you like SUI, again, I would wait. It looks very similar to GRT. You see there? It's actually on that resistance there, waiting for a little drop into that ascending support. Same as SUI, it's at that support resistance, waiting for a little bit of a drop into that rising support. So again, patience is key. I'm not saying we're going to get it right all the time. There will be many times that I get this wrong, but hopefully our trading technique saves us. And again, we just on our journey to turn that $10, well now 1033, up to 10,000. So if you're with me for the journey, welcome aboard and let's see what we can do. Have a good day, traders. All the best. Bye.